Hello and welcome to this edition of the weekly video market update, and I hope that you guys had a great and a safe weekend amid the second wave of coronavirus across the board. And as always, let's kick off this video with the topics that we'll be covering today. The US dollar technical turned negative at the end of last week. Is the retracement officially over? The US equities posted the second weekly gain in a row with its choppy trading, while there is no stimulus deal on the horizon as of yet. The British pound may face another wave of weakness ahead of the Bank of England negative rate decision. And finally, gold nearing $1,930 an ounce. Is this a new trend or another dead cat bounce? Beginning with the US dollar index, which showed a notable weakness at the end of last week trading after trading within a tight range and a boring trading throughout last week's trading until Friday, when the index actually broke multiple support areas in addition to multiple technical formations, including the inverted head and shoulders that we've been talking about for the past few weeks, at least on the daily chart, and the 50-day moving average in addition to the short-term uptrend line, while the RSI indicator is now below the 50 key level. Yet, such decline might actually not be the end of the retracement period, which began back in August, and this week traders should keep an eye on the 92.89, which represents its 61.8% Fibonacci retracement of the latest retracement wave, which basically began back in August. But a breakthrough that support would be the clearest signal that the upside retracement is finally over, or it's at least officially over, and the new trend is now in place. Therefore, don't rush into shorting the US dollar as of yet, especially that we are now counting down to the US elections. On the other hand, the US equities saw another choppy trading week, as there is no deal yet between the Democrats and the Republicans regarding the stimulus package. But what's funny here is that Trump refused the Democrats' $2 trillion deal and approved a revised package of $1.8 trillion deal, which of course was rejected by the Democrats. However, Trump said the same day, "I want a bigger package than both parties are negotiating." But how? Actually, nobody actually knows except Trump what he meant by this comment. Regardless, equities are still in buy the rumor, sell the fact mood. A deal is highly likely before the elections because also Trump badly needs it, but equities might actually not have more room to rise ahead. While once they actually announce the deal, we believe it will be the beginning of another correction ahead to the downside, which might actually continue for weeks. Therefore, don't also rush into long positions in US equities yet. From the US, let's move to the UK now. The British pound continued to rise last week amid the notable weakness of the US dollar, especially on Friday, posting the second weekly gain in a row, trading well above its moving averages on the weekly chart, yet it remains below the 50-day moving average on the daily chart. But in the coming days, in addition to the weeks or the coming weeks, despite the recent rally, the pound actually might be under pressure once again. And as earlier this week as earlier this morning, the Bank of England asked the local banks about their readiness for negative rates. Such move gives us a clear sign that negative rates are actually coming sooner or later, and the market is likely to start pricing in such move in advance. But this week, keep an eye on the 1.30 and 1.3080, which represents its 50% Fibonacci on the daily chart from the recent decline. And don't forget that the pound is still trading below its broken uptrend line, which was actually again broken back in August. Finally, we'll talk about gold, which managed to rise and close last week trading above $1,900 an ounce. However, gold is still trading within a new selling zone, which stands between $1,910 and $1,926 an ounce, which remains solid at least until this report is released. As long as gold continues to trade within the same range or within this area, the bearish outlook is here to stay, at least on the short term, while only a weekly close above that area would change the outlook once again. Therefore, we will be looking into some short positions later this week in the coming days, while stops should not be exceeding $1,936 for now, with a possibility to retest $1,900 an ounce once again, followed by $1,880 once again. That's it for this weekly video market update. Thank you all for watching this video and the previous videos. Please also subscribe to get the latest videos once they are ready on our channel. Follow us on our social media sites to get the latest economic releases, reports, and analysis. Thank you for watching once again, and see you next time.